Hi, I'm Sahil Kapoor. I'm Head of Products and Market Strategist at DSP Mutual Fund. Welcome to this 4th anniversary edition of DSP Netra. We've been writing this for about 48 editions. This is the 49th editions. And in this edition, we've tried to do something different. Nassim Nicholas Taleb, in his book, The Bed of Procrustes, said, to bankrupt a fool, give him information. In this DSP Netra edition, there is no information. There are no charts, there are no data points. This is the edition where we talk about randomness. So understanding randomness through aphorisms. This is what this issue is all about. I would emphasize that all the readers of DSP Netra and all of you who are watching this today have to do probably 3 things. 1, read all 5 books written by Nicholas Taleb in the Inserto series. Second, when you go through this report, which is available online, spend at least a minute on each of these illustrations and then probably read what we've written. And third, take a pen out and probably put your notes together. It will help you crystallize your thoughts as we go through this journey. The problem of induction. This is one of the most important behavioral quirk that people go through. When they look at data from the past or look at instances from the past, they extrapolate that into the future. The last few months, years, or even decades make us believe that what has happened in the past will happen in the future. Let me tell you a small story to tell you how different reality is. So on a turkey farm, a benevolent farmer comes every 11 a.m. and feeds all the turkeys. One day, there is Thanksgiving. And when the farmer comes, he is not so benevolent. And that is the day when turkeys face ruin. And this happens with all of us when we look at the data and we make certain assumptions that markets are going to fall, let's say 5% every year or 10% every few years and probably 30% in a decade or so. We begin to create paradigms that this will go on forever. But nobody knows the future. And there is a huge amount of danger in extrapolating the past, however strong it may seem on paper. Therefore, avoid the problem of induction. Do not learn the long lessons from the past. The black swan. There are events which are rare, unpredictable, extreme, and sometimes retrospectively predictable. We tend to believe that we can see them coming, but only in retrospect. So let me tell you an anecdote. I came to Mumbai on 15th July 2005. And on 26th July 2005, we had these Mumbai floods. On an average in Mumbai, in the month of July, it rains about 22 mm a day. On 26 July 2005, it rained 944 mm. About 760 mm of that rain came in just 10 hours. If you were to put a July day every second from the age of the universe, you will still not expect a 26 sigma event when you draw a normal distribution. This tells you that these events, which happen again and again, and many such rainfalls have occurred in Mumbai, they keep on repeating. Although statistically they look improbable and probably they will never happen, but they keep happening. Although they are rare, but they come. When we look at the past, we think that retrospectively it was very obvious. We can find flaws, we can find reasons to believe that we will be able to predict these events in the future and we'll be able to take actions to protect ourselves. But by the quality of the black swan, it's an extreme event. Our ability to predict the damage that it will cause is slim. Hence, we can't predict black swans. All we can do is prepare for them, and we'll talk about what this preparation entails in the next few ideas. Anti-fragile. During a 2018 auction at Sotheby's, Banksy's Girl with a Balloon started shredding the moment it was sold for $1.4 million. The piece of art had a shredder in the frame, and as soon as the gavel fell, the artwork started shredding. Many people thought that it will become worthless, but eventually it was accepted by the buyer, and in the next few auctions it was sold for $25.4 million, many multiples of what it was originally. This is anti-fragility. Things which gain from disorder, things which become stronger and better when stressors are introduced. Some things are fragile, that means they break if stress is introduced. Some other things are robust. That means they can take a lot of stress and still remain strong. But there are other things which are anti-fragile. That means when you hit them, they become stronger. A case in point is the old Hydra character in comics. When you try to kill it, it rears not one but two heads. So it doesn't go back to its original position, it actually becomes stronger. This is anti-fragility. So there are things in life which will become stronger, and for investors, creating portfolios which are anti-fragile is possible. Some of these portfolios thrive when things become problematic, when uncertainty is very high, when there are stressors and there are reasons of making mistakes. So think about anti-fragility, which is better than being robust or being fragile. Skin in the game. When you go to a barber and ask for a haircut, eventually you will get one. So if you want to know whether you need a haircut or no, don't ask the barber. Anyone making a forecast or gaining from the upside with an advice that is given to you, but is not exposed to the downside or the losses that may accrue, does not have what is called skin in the game. Take the example of people who are rappelling. There are two types of rappellers who help you or the novices to rappel. One who will go with you, who will tie his rope along with you and rappel along with you. That rappeller has everything to lose. If there is an accident, both of you fall. He has skin in the game. He also gets the upside in the form of the payment that he'll make once the rappelling episode is over. But there is also an agent who will take the money but not rappel with you. He keeps all the upside but doesn't get any downside which you are exposed to. Every time you look for any advice in financial markets, look at those people who have skin in the game. People who invest where their mouth is, people who invest along with you, who are exposed to the downside as much as the upside. Charlie Munger famously said earlier, incentives drive motivation, and skin in the game is a reflection of that. The ludic fallacy. People mistake map for reality and models for real life, but that's not true. Back in the day, in the 2000, I came to Mumbai and became a proprietary trader. I looked at long history of data and came up with strategies which beat the market handsomely. When I showed it to my senior trader, he asked me to knock off about 50% of returns from my Excel sheet models. And he said that that could probably be closer to reality. That's how real life works. My boss understood the ludic fallacy. Some people go into the labs, they test hypotheses on individuals, they play games, and then they try to project the outcomes on masses. But masses behave very differently from games. And the reason is that real life is not a simulation. Every factor can influence an outcome. And almost all factors which can influence outcomes are unknown to us. Therefore, don't fall for ludic fallacy or mistaking that real life is a game. Lucky idiots. Mistaking luck for skill. When you look at a strategy and in 99 or even more percentage of the time, it delivers excellent returns, it makes you believe that this is the holy grail. Or when you look at a pattern and probably identify random patterns and they start working, it gives you a false sense of confidence that you have found something which is going to repeat and probably going to make you very rich. Sometimes when we look at people who are extremely rich, famous, or have done very well in their life, we tend to believe that they have some specific skill. But many people gain from luck more than skill. And these are what are called lucky idiots. They may not have the skill to excel, but they have the luck on their side. Over a long period of time, lucky idiots do get run down by idiocy. As investors, we have to make sure that we do not fall for this lucky idiot trap. All we can do is that avoid to be stupid in our decisions, try to become skillful, and then let luck play its part on its own. Mediocristan and extremistan. These are the two terms which are extremely critical. Think about a restaurant where there are about 25 patrons having dinner. The average net worth of this restaurant is about $25 million. 25 people maybe $1 million each. And then Gil Bates walks in with $113 billion of net worth. This alters the situation of the room completely. With his entry, the average net worth of the room rises into multiples of millions of dollars. Suddenly, for the people standing on the outside, the per capita net worth of this restaurant will skyrocket. But real life is very different. Each patron having dinner is not so rich. This is Extremistan, where one single event, one single individual can change the complexion of the paradigm. On the other side is Mediocristan. Think about meeting people of different heights. Somebody will be 5 feet, someone will be 6 feet. On a rare occasion, you can meet a guy who is either 4 or 8 feet tall, but you will never meet 100 feet giants. This is Mediocristan. That means the averages are just averages. They move by a certain degree, but they are not extreme. Markets, specifically the stock market, resides in Extremistan. There are readings, events which are so out of whack that we can't even think about them happening. But they still do happen. Applying principles of averages is a mistake. In Extremistan, there are no averages. Averages won't help you survive. Markets are Extremistan. Non-linearity. Think about outcomes which are very, very large, but they take only a small input to fructify. Let's go back to the horrible episode of COVID. Back in 2003, there was SARS, Severe Acute Respiratory Syndrome. It did not become a global pandemic, and the reason was the spread or the R naught for SARS 2003 was between 2 to 3, and the asymptomatic spread was rare. That means that people got SARS in 2003 when symptoms became apparent. Contrast this with COVID-19, which is the second version of SARS. It had an R naught of 2.5 to 3.5, but the asymptomatic spread was very common. These tiny differences between these two episodes was the difference between millions of people dying versus a very selective SARS 2003 which got contained quickly. This is non-linearity. Tiny changes translated to effects which are magnified. As investors, you need to invest or probably take positions which are non-linear. How do you do that? Things which have what we call margin of safety. That means they don't decline too much, but on the upside, they can give you high returns or probably the possibility of making extraordinary returns. Although we don't know where the possibility will fructify, but there is a way to understand margin of safety, probably through value investing. And that's how you tackle the problem, and that's how you become a better investor. Always focus on non-linearity. Ergodicity. Think about two groups. Group 1, which is rope walking on 2 skyscrapers. There are about 50 rope walkers. Each one goes one by one and rope walks. Even if one rope walker falls, the game does not stop. It continues. The average outcome of rope walking is average for all the people. Think of a group 2, where only one person, let's say you are rope walking. If you fall, the game is over. You face what is called the risk of ruin. These are non-ergodic systems. Systems where the average outcome or your average outcome is not equal to the average outcome of the crowd, which means your ruin is only yours. But the average ruin or average outcome of the collective crowd does not matter to you. Think about the stock market. Collectively, over the last 25 years, the Nifty index has delivered nearly 13% CAGR. But think about many traders and investors who would have come to the stock market and probably lost everything. For them, this 13% does not mean anything. Therefore, whenever you enter non-ergodic systems, and stock markets are non-ergodic, the only problem to solve is the risk of ruin. Hence, a focus on margin of safety, focus on avoiding ruin and surviving will probably deliver much better outcomes than focusing on returns. The Lindy effect. survivors survive longer. Things which have persisted or lasted for, let's say, X number of years, let's say 50 years, are likely to last another 50 years. This shows robustness. This shows how things which have survived time have the ability to survive longer. Think about a humble toothbrush. The way we use a toothbrush today has been in existence for about 5,000 years. Maybe with different materials, but in the same form of a stick and bristles. There have been nearly half a dozen experiments and inventions created to replace the humble toothbrush, but all of them have failed over time. And the reason? Some things do not need innovation. Time eventually destroys everything by finding a weakness, but things which survive time have the ability to survive much longer. Hence, as investors, we should be very careful in running after new fancy ideas, running after catchy recent themes. The better outcome or the better way is to focus on things which survive with time. They will probably keep you alive in stock markets and help you with better outcomes. Via negativa. Be deeply skeptical of the idea that we can improve things by acting more, by doing more, or by adding things. Knowledge, in fact, is subtractive. We gain more by removing things which cause harm or fragility in the system. Think about people who are on a side hobby to lose weight over time. Most of these people will run after the new diet, the new pill, new equipment, or a fancy new workout. This is what is called medical iatrogenics, where introduction of things are expected to improve outcomes. In fact, the better approach could be to avoid things, maybe like smoking or sugar, which cause fragility and cause harm. This is the via negativa approach. Creating a not to do list, making sure that you don't go in the direction which causes harm. Charlie Munger had this famous quote, "Tell me where I am going to die and I will not go there." This is the standard via negativa approach. Absence of evidence is not the evidence of absence. When we look at past data, we tend to think about patterns that we are able to identify. We can see the evidence of all that has happened. But there is also something called as a silent evidence, the unobserved, the unavailable in the data. We miss that because it's not apparent. But it does not go away, which means that its absence is not the evidence that it is not going to be there. This is a critical mistake that we make. When we look at the history, we think that we know everything, but future surprises us with events which were possible, but we could not see them because they were not present in the data. Hence, absence of evidence is not the evidence of absence. Think about the numerous accidents which happen when novices miss, for example, the iceberg when the Titanic was sailing, or think about people who've joined the stock market over the last 5 years have never seen a 20% decline. For them, a GFC era 60% decline appears impossible. For many who run 10-year strategies, it will not even feature in their backtest. But reality is very different. The worst of the past is not by definition the worst of the future. It could be even more bad. And that's why it's very important to look at data and remain humble and open to sense of surprise. Books that were read, reread and left unread. There is an Italian novelist and scholar, Umberto Eco. He had a collection of 30,000 books in his personal library. When people visited his library, they were awestruck and amazed and often thought how many books would Eco would have read. In fact, Eco kept this large volume of books, of which many were unread, as an epistemic humility, as a symbol of what he did not know. All the books that he had read, presumably many, it told him what he knew, and all the unread books told him what he did not know and kept him humble and hungry for more knowledge. There is also a Japanese concept of sandokus. People who love books and they keep buying books and keep them piling on in the hope that they will read them in the future. This is not for people who only buy but never read. It is only for the readers. This concept of unread books providing you the humility and keeping you hungry for more knowledge represents the idea of NT library. It's much easier to create NT libraries and keep on learning new things. As an aside, we would wish all our investors read, reread, and probably left some books unread so that they gain knowledge and remain hungry forever.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.